Welcome to Real Estate for Real People, hosted by Shannon and Tamara Stone. As award-winning real estate professionals, the Stone sisters have spent years helping people navigate the complexities of buying, selling, and investing in real estate. From first-time homebuyers to seasoned investors, Real Estate for Real People is the go-to resource for anyone looking to make smart decisions in the world of real estate. So sit back, relax, and get ready to learn from some of the best in the business.
Hey everybody, it's Tamara with Stone Sisters. Thank you for tuning in again to another issue of Real Estate for Real People. And I'm really excited about today's guest because it's my husband, but it's also going to be really interesting. And he's going to share some intriguing and interesting ideas with all of us that will help us all in our real estate investing and real estate ownership. So for those of you who don't know, my husband is Derek Moran. And he's the owner and founder of a company here in Kelowna, BC, called Smarter Financial Planning, and has a great website. It's called whencaniquit.ca. And Derek, tell me your ideas. We're going to talk today about
three simple $10,000 ideas. And depending on where you're at in life, some may apply to you, some may not. But it's great if you've heard about this stuff and kind of understand it, and maybe you can share it with somebody else. Who knows?
Well, I think it's good. I mean, a lot of people, and Derek, you and I talk about this at home all the time, but lots of people go, oh, wow. So you're a realtor and your husband's a true fee for service financial planner. And it's, what a good pairing. And of course, there's a lot of sort of cross ideas and influence that you have that, some smart things people can do to invest smarter, to retire earlier, to have more. So
perfect. Thank you, Tamara. And we're going to talk about a whole bunch of things. Lending. We're going to talk about insurance. We're going to talk about trusts and estate planning. But I don't sell any of this stuff. My job is just to give people information. I charge an hourly fee, much like an accountant, and it's your job to go out and sort of make it happen.
Okay, I'm going to pause you there, Derek, because it's unusual. And so many people have no idea what that is or really what you're doing. So just before we get into your three $10,000 ideas, so you're going to save people $30,000 today. But can you talk a little bit about what that means, about how that's different? So you describe, if you can, to someone who doesn't know, because some of our listeners will have absolutely no idea what that means.
My job is to be a comprehensive financial planner. And it really focuses around when can you quit work and what will it take to get there? And that's really the focus of the area. But there's all these sort of spin-off areas that happen as well. How much tax am I going to pay? How do I reduce it? Do I need life insurance anymore? If I have an extra $1,000, should I pay down debt? Should I put it in my RSP? What should I do with it? And my job really is just to give you information so that you can make more good decisions. Mm-hmm. And I think when people have the information and they understand it in context to their situation, that's what happens. They get ahead faster.
I love that. And it's, an analogy I use when I describe what you do, because I think you hear financial advisor or financial planner and people go, oh, okay, so you're selling stuff. And an analogy I like to use is that if somebody won $1 million and you come to me, for some advice, I'm going to sell you a house. I'm going to try. And if you go to a broker, stockbroker, they're probably going to try and sell you some stocks or some investments. And, same with somebody in insurance or what have you. So what I like about what you do is that you truly look from an unbiased point of view and look at the whole situation and go, okay, we've got debt over here, pay that off or do this. And it's a little more unbiased than others, including myself.
Yes. Thank you. That's the point. Yep.
Awesome.
And there's only about 100 of us across the country. So if you're in Toronto or somewhere, there are fee for service or fee only people certainly there.
Mm-hmm. Mm-hmm. But you work with people across the country. I mean, around the world, really.
Really all over the world.
Yeah. I love it. Okay.
I've never met.
Yep.
I was going to say about 90% of the people I work for I've never actually met in person. So sort of a strange business in that sense, but.
Kind of nice though. I'm sure people like the anonymity of it all, actually. So sort of a hole in the wall to talk to and get some advice. So with that, I won't drum roll because it'll probably sound weird on the podcast, but why don't you launch into, if you'd like to, your first $10,000 idea?
Okay, perfect. Thank you. Number one is I'm always trying to find ways to cut costs without cutting any of the fun. And one of the big areas where I often find opportunity is insurance. So we're going to talk quickly about house insurance and life insurance. I just went to renew the insurance on my truck, and the girl took the opportunity. She'd been well trained to say, "Do you have your house insurance with us?" And I said, "No." And she said, "Wonderful. Can we quote you on it because we love your business?" And I said, "Great." And right now we pay about just under $1,400 a year. And so she came back with this quote. She was so excited. It's like she was ready to sign me up. She was so confident she had the business. Her quote was over $2,400.
Wow.
And she'd ask me all the questions, tell me about your roof, tell me about your hot water tank, tell me about, all the house insurance stuff. How big's your house? Where is it? Blah, 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 blah. And there was $1,000 difference. So yeah, message number one is shop around for house insurance. We use a company called Monex, which was bought by TD. I think if you search TD Malosh or TD Monex or something like that, it will come up. And within sort of half an hour, 45 minutes, just on a toll-free number, they'll give you a binding quote that you can compare, and you can switch right away. You don't need to wait till yours and your annual mortgages or your annual insurance is up, sort of thing. And it's a simple way. And if you say, okay, well, if I just did that for 10 years in a row, there's $10,000.
Yeah. Yeah.
And
how do I spell
honestly,
Melosh? Because I know I have clients ask me all the time, and I can't.
Meloche.
Melosh.
They're based in Alberta, I think. And another one is called Sonnet, like the poem, sonnet.ca. I've heard people also say they got really good rates from there. Wow. There's probably more, but there's an amazing amount of, and if you have a number, let's say you have 5 rental properties. Now maybe this is a $50,000 idea.
Right. Right.
So
I love that. So that's your annual insurance, damage, fire, water, what have you, on your house. Can we talk as well about insurance, about mortgage insurance? And are you going to get into that? Because I know that's a big one. And I remember hearing that 29 years ago. Yeah.
Yep. Mortgage insurance is just life insurance. The kind you get from the bank is generally of lesser quality. You don't actually have a binding contract with them. They just make a bunch of assumptions up front, and then they kind of do the research later if you make a claim. So, and it's about 3 times as expensive. The kind most of us should have, more than 99% of us, is just simple term insurance. And you want the shortest term possible. They used to offer 5-year, 10-year, 20-year, even term to 100, they call it. I would get the shortest term you can. It's unlikely you're going to see term 5 out there. We don't really see it anymore. But basically, it's a fixed cost, binding agreement, and it's the most cost effective. I don't want to call it cheap, but it's much, much less expensive. You don't want to get into the whole life policies, the universal life policies. They'll sell you on all these great ideas of how it's a great investment and stuff. But when you pare it right down to what they call net pure insurance costs, it's about 10 times as expensive. And for most of you, it's just not where your money should be going. You're much better off just to use that money to pay your mortgage off faster, or put more money in your RSP, or take a trip to Disneyland, or whatever.
So I'm going to back you up a little bit, because you talked about as short a term as possible. What is that? What's the ideal term? Okay,
well, the time in life when most of us buy life insurance is when we've just bought a house, or just having our kids. Our spouse is not working because she's with kids. It's when you're the most broke, and it's when you need the most coverage. You're the most vulnerable. Your mortgage is probably the biggest. Your kids are the youngest. Your spouse is not working. You've got all these vulnerabilities, and you feel broke because you just went from a few years ago you were double income, no kids. Of the times of your life had 2 paychecks and far fewer expenses, and then this comes and you feel like, oh. So this is the time in life where we're trying to keep the costs down. This is also the time when you really need the coverage.
Right.
So,
So what term what would you recommend? So I'm going to assume I've got
the
clients who
shortest
are
term, you're
30.
probably going to get term 10 right now. So fixed cost for 10 years. And the
Okay.
reason why I suggest as shortest term as possible is my guess is in 10 years, you won't need as much life insurance. So if you
Mm.
get say a 20-year term and then you reduce it after 10 years, you've essentially prepaid insurance you're never going to use. You don't want to do that. It's just a waste of money.
Okay,
So
but just sort of playing devil's advocate. So let's assume this theoretical couple we've got buying their first home, and I'd like to dive into a little bit about the banks, because I know the banks really encourage, I'm not going to say push, I guess it depends on who you're dealing with, but they really want you to sign up with their mortgage insurance.
of course,
So this couple we've got are 30. So they sign up for 10 years. In 10 years now they need to reapply. Health
no,
should be
no.
okay.
Life
Okay,
insurance,
pardon.
generally speaking, I've never seen a policy. I guess they're out there, but they're pretty much 100% automatically renewable,
Okay.
without any sort of medical proof. You can't increase it, but it's automatically renewable.
Okay, so again, let's assume this couple's 30. They buy their first house for 800,000, and
Mhm.
in 10 years they're not, they've maybe had their kids or they've gotten promotions at work or what have you. And now they're buying a house that's 1.5 million.
Mhm.
So if they can't increase it, would they not be wise the first time they're getting insurance to go right up to get a bigger policy, or no?
Well, yes, a bigger policy in the sense of more coverage, but not a more expensive policy that has more options.
Okay. Okay.
Um,
Yeah, I like that. Now let's
so
jump over for a moment and talk about the banks and talk about term insurance, or pardon me, not term insurance, but mortgage insurance. Because I know, or my understanding, and maybe you can correct me on this, Derek, but my understanding, you get insurance from the bank. They insure the amount that couple buys an $800,000 house. They put down 80,000. The rest is financed. They get the insurance from the bank because it's quick and easy, and you're just signing everything anyway. You don't even really often know what you're signing. It's pretty fast. You got to be pretty astute to not sign up for it. Then in 5 years, you've paid off 200,000 or more, what have you, of your mortgage. If something were to happen to one of you, it's whatever amount is owing on that mortgage that gets paid out.
that's absolutely true. That's another good piece of the puzzle. You don't
Yeah.
get the original, let's do an apples to apples comparison. In the first situation, they had an $800,000 mortgage and they
Yep.
paid it down to 600,000.
Yeah.
Yeah. If you bought the term insurance and you died, you get 800,000 or whatever whatever you paid for. Maybe you get $1 million, $1.5 million, something like that to cover off all the other issues.
Right.
With the mortgage, only, as you said, only the outstanding mortgage is actually what gets paid down. And even worse, you may be mortgage free, but when somebody dies, the first thing you need is cash. And you don't actually get the cash. Whereas with the life insurance, they give you the check and they say, if you want to pay down your mortgage, go ahead.
Right.
But it's totally up to you. You have
And
much more flexibility.
what will that cost? And maybe you don't know this, Derek, because I know you don't sell insurance, but ballpark $800,000 mortgage. Do you know, $800,000 policy?
It depends on your age, your gender, and especially if you smoke.
Awesome.
That's a
Okay.
big one. Smoker rates are about double.
Wow. Okay. So
So I
that's
had yep, sorry.
no, go share your situations. This is super casual. So this is great.
I don't know how much time we have, but I have a great story of a couple in Toronto, and they were early 40s, 3 kids under 10, big mortgage, one person working, and they had this whole life insurance policy. They had 150,000 of coverage, and yet they had a $800,000 mortgage, 3 young kids, wife not working. I mean, all the risks. And I said, why do you have this policy? It was a story in the Globe and Mail. And for the same cost of the $150,000 fancy life insurance policy, they got 1.1 million of the kind of insurance I like, the simple term 10 coverage.
Wow.
And about 2 years later, she was crossing the street and got hit by a bus and got killed. And all of a sudden, I didn't work. It was just a one-time situation where I'd interviewed them and they'd written a story in the Globe and Mail about it. I hadn't followed up with them, and he phoned back and said, "Hey, here's what happened." And it took me a while to even piece it together because I didn't really remember the story. But all of a sudden, it was like, wow, the impact of this stuff. Holy.
Wow. That's
So
incredible. Okay. So that was the first tip. Insurance, whether it's your life insurance, whether it's mortgage insurance, whether it's home or vehicle insurance. Get some quotes, dig around, ask questions. So that was idea number one. Let's.
Okay, I'm going to throw a couple. Can I add a couple things onto that?
100%. Yeah.
Always check into paying once a year as opposed to monthly. It's with life insurance, it's about 5 to 8% less expensive.
Wow. Right.
Sometimes it's the same price, like with ICBC insurance, which is in BC car insurance. It used to cost 15% more if you paid monthly. I think it's the same now. I don't think they charge a premium for it. So find out about that. And if you're an incorporated professional, talk to your tax pro about having the life insurance owned and paid for by your corporation, not by you personally. There's a few, it's not as simple as saying just do it, because there's a few pitfalls and problems you can create by doing it. But ask them. Because you might
the reason
make the
for that
premiums
would be got you.
Well, the insurance costs become tax deductible, but the payout is still tax free.
Wow.
So
right?
yeah,
Good tips.
it's a win-win. That's about it.
Now we can go to idea number two.
Okay, number two is if you're over 65 and look in that situation where you're selling your big house and downsizing, retiring to a smaller place, to a condo, to what I'm going to call your last house, consider setting up a trust and putting your money in the trust and having the trust buy the house. You control the trust, you're the trustee, but it's a probate avoidance tool. In most provinces, if you're from Alberta, you can ignore this for probate reasons anyway. There's other benefits of it, but you can set up something. If you're a single person, it's called an alter ego trust. If you're a couple, it's called a joint partner trust. Why they have two names, I don't know. But essentially, you don't own the property. So when it comes to settling your estate, it doesn't go through your will, so it's not subject to probate. And probate in most provinces, Quebec, Ontario, and BC are the worst ones. It's around 1.5%. So if you use a simple example of $1 million house, it saves you $15,000. Bam.
Wow.
So now the downside is there's more complexity in your life. The trust has to file a tax return every year. You have to have another bank account. The trust has to have its own bank account. So it's a bit of a pain in the sense of more paperwork, but it's certainly something to talk to your accountant or, lawyer or estate planning people about. Especially if you have a really expensive house. And also this trust can own all of your other stuff too. It can own your corporation very easily. If you own an existing home where you've already moved into your final home, it probably doesn't make sense to set up, because to move your home from your personal ownership to the trust, you have to pay the property transfer tax all over again. So you end up paying 2% to save 1.5% or something. It's not worth it.
No. In
BC, you have a homeowner's grant and seniors grants and things like that. They're somewhere between where you would know, $800 and $1,000 a year savings if you live in your home.
Yeah, not quite that high, but close. Yeah, $670 and close to $1,000 if you're over 65.
Okay,
that you get off of your property taxes.
You'll still be eligible, even if the trust owns the home. You're still eligible for those.
Oh, okay. I didn't know that. I would have assumed they'd lose that. But
you still have a tax-free gain on the home in the sense of if it's your personal residence, that nothing changes from that perspective.
Now, there are some obviously more associated costs. You have to do a tax return. You'd already said that, right? For the trust.
Yes.
This is probably applicable for people with a more expensive home or a higher net worth than
certainly. And as you said, you can take a whole bunch of other assets. Let's say you have a whole bunch of other money, investment accounts, things like that. You can roll those into the trust. If you're over 65, you can roll those into the trust. And even though it's normally considered a change of ownership as what they call a deemed disposition, which means that any capital gains in the accounts would theoretically have to be triggered and then a bunch of tax paid. If you're over 65, you're exempt from that capital gain. So it's a wonderful estate planning tool.
Okay, so just to summarize that one, consider purchasing your last home within a trust, or certainly look into it and weigh out the costs and pros and cons.
Talk to your tax people.
I love it.
Yes.
Okay, that was a good one. And third,
number 3, this is the one I'm excited about. Let's say you're buying a home with a suite in it, or you're buying a duplex and you're going to live in half of it, or those kind of situations. Pretty common out there.
I'm going to pause you because we're seeing a ton of that right now. I think as Kelowna real estate's gotten more expensive, I think as we've got the sandwich generation buying, a place for their kids and or their parents or what have you, there's a lot of this. Throughout BC, they've made rental suites, they've opened the doors up considerably and there aren't the restrictions to having suites like there were. So this is timely. I like this one.
Okay, perfect. And this is way bigger than 10,000 this way.
Okay.
So let's do a simple example. Tamara, you and I, we want to buy this duplex. Let's just call it, I'm just going to make up numbers here, say it's $1 million for both sides. I know that's laughable in Toronto and Vancouver, but in other parts, that's maybe high. Yeah. In Kelowna. And let's say we have 400,000 to put down. So we're going to borrow 600,000, buy this place. You know what most people do? Because it's a duplex, you're going to be collecting rent from it, which is taxable, but you're also going to, because let's just pretend both sides are identical and the yards are the same. Everything is 50-50 on the 2 units. So theoretically, you're going to be able to expense half of your house insurance, half of your, all the utility bills for that side, half of the property taxes, half of all the costs incurred because half of it's for business purposes. Now, what I'm suggesting is, and this only works when you're buying it, is that you figure out the value of the rental part of the property. And then you allocate 100% of the financing or as much as an amount equal to its value. Okay, let's go back for a second. I'll make it less confusing. What most people do is with the $600,000 mortgage, most people would have 300,000 allocated to the rental side and 300 allocated to the personal side. Now, the interest on the personal side is not tax deductible, but the interest on the rental side is. So what I'd suggest people do is get some sort of an appraisal or some sort of an opinion, professional opinion or something of what's the value of the rental side. And then allocate of the $600,000 mortgage, allocate 500,000 of the debt to the rental and 100,000 of the debt to the personal.
Because you get a much bigger, challenging to do if it's an identical side-by-side duplex.
Why?
Well, how would you argue that one side is worth 100,000 and one side's 500?
Well, it's not. It's just that you put a down payment down on the personal side.
Got you.
As long as you document it correctly up front,
you're fine.
It's perfectly clear. Yeah. So let's go back to the original and say, okay, we put down 600,000. We didn't allocate more to the business side. So interest rates are what? I don't know, 5%. I'm just going to make up a number these days. So you would get $300,000 mortgage, 5%. That's $15,000 a year of tax deduction against the business income. Now, the way I'm doing it, you'd get $500,000 times 5%. So you'd get a $25,000 tax deduction.
Wow.
So you get a $10,000 more tax deduction, which is worth, in your jeans is worth something like 28 to 55 cents on the dollar. So on your $10,000, it's something like $2,800 to $5,500 a year.
Wow.
Now, as the mortgage goes down, the interest will go down, and so that number will slowly go down. But
now that's
if you
something
start to do it over 10 or 20 years,
lets me think about. I know you say for people to pay off their mortgage, their primary residence portion of the mortgage, pay that one down because it's not tax deductible, and then on the rental portion, you actually want to keep it as high as you can. Right.
Okay, now let's go into that further because banks will now, most lenders, I haven't seen one now that won't, I haven't explored them all, but will allow you to have separate tiers of first mortgages within your home equity line of credit. So what I'm suggesting is get, if we go back to the duplex example, get a $500,000 mortgage for the rental side and get a $100,000 mortgage, totally separate, both secured by it, but completely different. And then when you have extra money to pay down your mortgage, just pay the personal side down. I want you to pay the rental side off as slowly as possible, and I want you to rent the personal side as quickly as possible.
Wow. Okay.
And if you go back to the way, the way most people do, which is to have 300,000 allocated to both with one mortgage, as you pay down the mortgage, you're paying off good debt. you're paying off business debt, which is not what you want to do.
Right.
So super easy way. I don't know.
Wow.
That's kind of probably at least a $25,000 or $50,000 idea. If you're going to own the rental property for 10 or 20 years. It's amazing how valuable these things become.
Wow. So those are three incredible nuggets, and we've chatted a lot before recording this, or, having you come on our podcast, but just talking about ways that real estate and smart financial planning do tie together, and some of the things you can do prior to even, purchasing, just things to think about, as you're looking at acquiring a rental property, or downsizing and buying your last home, which often is a downsize in size and an upsize in price. But, trying to think about things, rather than just sort of jumping and making quick decisions, and just ensuring that you're doing things the smartest way possible.
Mm-hmm. Do I have 2 seconds? Do you remember, do I have 2 seconds for another insurance thing?
Yeah, lots.
We have two daughters in university. The youngest one is moving out of residence. She's going to go into second year next year. So she has to go and find her own place to live. And part of the rental agreement is that she must have tenant's insurance, and she must actually show proof of it. And so she went and explored it. It's $360 a year. And then she said, but some of my friends are covered under their parents' home insurance. So I just wanted to check, am I covered under that? And I just I thought, yeah, not a chance. Not a chance. Right?
Different province.
You know what? I'll check into it. And so I phoned the insurance company, Milosh and Monix, again, they should get a plug for this. And the cost was $3 to put coverage on her. $3 for the year.
Actually, it was $3 for both the girls, wasn't it?
It was $3 for Morgan, and then I added Alexa too, because she's and she was $1.
Wow.
So for $4, they have tenant's insurance, living in Ontario, 3,000 miles away.
Yeah. Wow.
And liability, everything.
Yeah, that's good.
Wow.
Because our eldest has lived away at school. She's been out of residence now for 2 years, and hasn't had insurance, which, we didn't know. It wasn't required. We didn't really think about it, but it's smart to do. And, just the question hadn't come up until Morgan needed it with her new rental. So
I would never have guessed.
No. Well, you saved $600 there.
Yeah.
I can go shopping for shoes.
Yes.
All right. So any last minute thoughts, Derek, before we wind up here? I mean, those are some great tips, and we're going to share where people can find you, and you write a great optimism newsletter. How often do you send that out?
Whenever I get good ideas.
Okay,
every 2 weeks or so.
Yeah. Because I love that newsletter. And of course, my husband, I love reading it, but you've got all kinds of tips and ideas and optimistic stories of things going on out there. And I would really encourage any of our listeners to go on your website, to sign up for that, and just start to pay attention, or pay more attention to perhaps a different perspective. So how can people find you?
Whencaniquit.ca.
Excellent. And it's
thank you so much for having me.
Oh, that was fun. That was really good. You did well, honey. Thank you, everybody, for listening. And if you have any questions at all, you can always reach Shannon and I at stonesisters.com. We will continue to try and bring interesting guests and hot topics about owning real estate, or different things about life in the Okanagan Valley. As always, we're here to help if you or anyone want to buy a home. Thank you so much for tuning in.
Thank you for having me.
Thanks for listening to this episode of Real Estate for Real People. If you want to reach out to the Stone Sisters, visit www.stonesisters.com. This podcast was produced by Podigy Podcasts. See you next time.